I'm going to talk today about something that needs to be thought about, and that's whether when you open a trade, the question is whether you're buying an option or a lottery ticket, and I'm not sure a lot of investors think about that. Now remember, if you find this information useful, or if you like the video, please click below to subscribe. So let's get to the question here. Many individuals speculate with options, and often they start with the belief that options are an alternative to the stock, but that's not quite true. An option gives you exposure to the stock, but an option carries other factors with it. The option will cost less money than the stock. It'll have an expiration date, so time becomes a factor. And the price of the option is actually derived from the value of the stock. There, at times, even appears to be a non-direct correlation, so it's very important to remember there's differences. Winning investors trade options, not the stock. And that's because it's possible to be right on the stock, watch the stock go up, and still lose money on the option. So there's always a decision. Is this the right stock? And then is this the right option? And winning investors do that full analysis. What's different about options is that time is an important factor, as is volatility. If you own a stock for the long run and you follow the Warren Buffett school of thought, you ignore day-to-day changes in the stock. When volatility increases, you may even buy more, thinking it's a good opportunity to gain exposure for the long run. And the long run is an undefined time period. With an option, there is a defined time period from the moment you look at the trade. Each option carries an expiration date. In lottery speak, you know when the drawing is when you buy the ticket. Well, you know when the option expires when you open the trade. So you have to factor in time. In many ways, option markets are like tennis, and there's an old paper in the financial industry dating back to the 70s written by Charles Ellis, an investment analyst, that highlights how tennis is actually two games, and golf is the same way, other sports are the same. Professionals win points and they play a winner's game. So if you look at tennis, the pros are all hitting good shots, and generally the pro hits a shot that's just a little bit beyond the reach of their opponent, and that's how they win. For the 99% who aren't at that level, it's a loser's game. Rather than trying to hit the shot where your opponent's not, you're just trying to hit the shot somewhere in bounds. And most points are going to be lost when somebody hits out of bounds. Mistakes end up being the key factor in determining who wins or loses. The person who makes the least mistakes ends up winning in the loser's game, whereas the better player wins in the winner's game. Now, studies show options markets break out nicely in that winner game, loser game mentality. A lot of individuals tend to play a loser's game, and a lot of professionals play a winner's game. Studies show there's persistency in performance. Winners continue to win, losers continue to lose. And that's because of how they frame each trade right at the beginning. So it's possible to set yourself up for losses in the long run right at the beginning by simply buying the wrong option. In order to understand what the wrong option is, we need the idea of moneyness. So options can be in the money, at the money, out of the money. Out of the money are cheap. In the money can be very expensive. At the money is a great place to balance risk and reward. Many individuals use out of the money options because they're cheap. And many people standing in line to buy a lottery ticket will tell you they're doing so because it's only $1. And they're only betting a small amount, and look at how much they can win. Well, that same mindset can affect options buyers. Let's look at a stock trading at $100, and there are then many options. We're only going to look at 3, and in the money, at the money, and out of the money. And the out of the money, definitely the cheapest. If the stock goes up, that out of the money has the potential to deliver an incredible gain. The in the money is very expensive, but it can also deliver a good gain. And I think that's what we forget is in investing, singles hitters, so to speak, can be just as profitable as home run hitters, even more so because they can be steadier and consistently earn money. So the option selection is probably the most important factor. Professionals tend to trade, according to studies, at the money or in the money. Individuals tend to trade out of the money. The options price carries a lot of information. That out of the money is only trading at $1 because it's very unlikely that it's going to hit. It's just like the lottery ticket. It's only trading for $1 because it's very unlikely to be the winning ticket. Prices are correlated with success. Out of the money options have a low probability of success. The higher the option price, the more likely it is that that option trade will work. Now, like I said, traders find their own balance. At the money presents a nice trade-off between risk and reward. So consider that as you're buying options. Are you buying a lottery ticket or are you buying an option that could deliver a gain? Lottery tickets are fun, but they make very few people into winners. And that's the same that's true in the stock market. So I hope you enjoyed this video. If you did, consider clicking below to subscribe. And we'll be back with more videos from time to time explaining concepts like this that can help you stop playing a loser's game and start playing a winner's game. Thank you.